Welcome to Make Your Money Matter with Brad Barrett, the show that aims to change the way you think about wealth management. Brad is a financial advisor, established radio host, and author of Retire Right. He is a managing director and partner at One Capital Management, an SEC-registered investment advisory firm managing over $4 billion for clients across the nation. Brad and his team are dedicated to helping clients protect and preserve their assets so they can reach their investment and retirement goals. And now, your host of Make Your Money Matter, Brad Barrett.
Welcome to Make Your Money Matter. I'm your host, Brad Barrett. I'm also a managing director and partner here at One Capital Management. And our show each week is aimed here to help you have a better relationship with your money. And I wanted to touch on a subject matter here on our show around the history of the United States debt. Now, I focus on this simply because, as I've been sharing here over the past few weeks and really the past few months, in that the national debt, our U.S. debt ceiling, has obviously been in the news and it's just disrupting markets here and there. But now that we're seeing a debt deal come to fruition here, I thought it'd be interesting to go back and look at the timeline. And I went all the way back to our Independence Day, 1776. So I hope you're going to enjoy some notes here. I'm going to relate that to what we're seeing. But before we get started, make sure to go to our website at onecapital.com. You can click on our media tab, and there you can download and subscribe to the Make Your Money Matter show. You can also download the podcast on any other platform like Google Podcasts or Apple iTunes app on your phone or Spotify or SoundCloud. And do me a favor, leave us a message. It's a way to carry this podcast into others so we can broaden it and make sure we talk about more investment topics for all around. So with that, let's get started. So again, going back to 1776, here's the timeline of federal debt. And I think it's kind of interesting because it brings us to date to where we are right now. Okay, starting out right out of the gate, the Continental Congress, if we look at our history, U.S. history, and for anyone who, watches or listens to our show, I'm kind of a buff and a nerd about this kind of stuff. But the Continental Congress at the time could not finance the Revolutionary War with large tax raises. And here's the reason why, okay? Because here, get this, right? The unjust taxation from the British was the exact reason, right, behind the whole rebellion, the colonist rebellion against Britain to begin with. So we couldn't do that, right? So instead, what did we do? Here's, friends, where the U.S., are now, the United States as we know it today, started borrowing money. And here's what's interesting. We started borrowing money from other nations. Ben Franklin secured loans of nearly $2 million from the French government. John Adams secured a loan from a Dutch banker, as well as some domestic creditors as well. And honestly, when the war ended in 1783, the newly formed, at this point, the Department of Finance, they actually reported the U.S. debt to the American public for the first time, and Congress actually took action then to raise taxes. The total debt at this point, here's the first marker, was $43 million. Now, by 1815, the War of 1812 had actually caused that national debt of $43 million to increase to $119.2 million. Quick aside, President Andrew Jackson at that time sold off federally owned Western lands and basically blocked spending on infrastructure to pay off the national debt after 6 years in office. I actually find that kind of interesting, but I digress. Now, moving along, Civil War. The Civil War cost us, the United States, $5.2 billion when it ended and caused the national debt to balloon to now, at that point, $2.6 billion. Moving past that, we went to the Great Depression, and obviously with government assistance programs started by really FDR, caused the national debt to hit $33 billion. That was a massive expansion right there. Now, after lending other countries money to help pay their military costs for World War II as allies, our national debt, though, hit $285 billion. Quick checkpoint, right? Just previous to that was the Great Depression, and we were at $33 billion in national debt. Now we're at $285 billion after World War II. Now, fast forward, in the 1980s, obviously the increases in our defense spending, coupled at that time with Reagan's tax cuts, caused the debt to grow to $2.7 trillion. And by the way, there was a minimal increase. This is what's interesting, right? There was actually a minimal increase in the federal debt until well into the 2000s from the 1980s. So that's, you got to think trickle-down economics does actually work, friends. But by 2005, the federal deficit was more than $8.1 trillion. But after the Great Recession in 2008, it had grown to $12.3 trillion. Now, friends, we get to where we are at now. Now, before we go right now, let's go back just a couple of years ago. Fast forward here, right, to the pandemic of 2020, right, and obviously followed by multiple rounds of stimulus packages, and the national debt, right, hit $28 $1.2 trillion by basically end of April 2021. Currently, we're sitting at about $31 trillion and counting. There, my friends, is the timeline of U.S. federal debt since Independence Day, 1776. Why am I sharing that with you? Obviously, with the debt ceiling going on, we've had a national debt since the birth of our nation. And obviously, looking at it per capita relative to the GDP and the GDI, most of you don't know GDI, but that's the gross domestic income, which relates a lot to the gross domestic production that we all hear about. But if you relate that to then, it's actually still well in line. Now, an analogy I was sharing with a client the other day, and I want to share this, is this. We have, let's say, $31 trillion in debt as a nation. Obviously, this is a dramatic scenario, and this isn't exact science or exact numbers. But basically, if you look at all the assets that the United States has, it's right around or just over $200 trillion. Okay, let's relate that to our world because those numbers are just ridiculous, right? So would you be overly concerned with a $31,000 mortgage on a $200,000 home? Now, I'm not going to answer that for you, but it poses the question, if we relate it down to scale, to something that we can understand, I can understand at least, right? I'm not overly concerned there. What I am concerned about, obviously, is the fact that my mortgage is going up and not down in my analogy. So that's number one. But number two, I'm also looking at that I have a lot of equity and a lot of worth, if you will, to substantiate my debt. Now, further than that, in that same analogy, when you break down the actual debt percentage cost that we're paying, our debt as a whole, the $31 trillion that we're talking about, as the end of 2022, costs us 2.07%. Now, why I'm bringing this up, even if we have a nominal growth of 4%, to me, there's plenty of growth to cover the cost of borrowing. Now, I shared some of those stats on a previous show, but I wanted to go one step further here and bring this into some perspective on my analogy, right? So if we think about the $31 trillion in debt, and we just start right there, and let's say we maintain that for a second, right? That currently is 12% of the total federal spending. So the debt itself is 12%. So again, what we're servicing, which is what this whole debt ceiling conversation is about right now, is 12% of the budget. So going forward, what I want to share is this. For the long run, the Fed expects real economic growth at about 1.7 to 2%, with inflation in the long run of 2%. So those two together give you nominal growth. That's where you get to that 4% number. Again, expected growth here exceeds the cost of borrowing.
Stay connected. Get frequent updates on the show. Follow Brad Barrett and Make Your Money Matter on most social media platforms. And catch full episodes of Make Your Money Matter streaming now on our YouTube channel. To schedule your no-obligation appointment, go to onecapital.com or call 805-410-5454.
I want to share this loud and clear, and I don't want to sound like I'm beating a dead horse on this topic again, but I think context matters in what we're seeing about the debt ceiling and what we're seeing about our investments. Now, you can see that the market is actually not reacting too negatively to what's going on, or positively. When the debt deal was actually announced and signed, the market reacted somewhat very little. Now, going further than that, there's fundamentals that we need to look at as an investor, which we do as a portfolio manager for our clients, in understanding the fundamental value within these companies and making sure that their things like price to earnings and earnings per share are still in line with the data that we're being given. But I think the volatility that's been coming off of last year with supply chain issues, inflation, and then obviously into this year last year with the war going on, and then obviously into this year with raise of interest rates and obviously the debt ceiling conversation, it's worth bringing back up as a notion to discuss because context does matter. And that's why I wanted to share one thing that I think being perspective on this is we've always had debt. We've never had a nation. We as the United States have never been a nation by ourselves, united as we stand, without debt. I'm not saying that's good or bad. I'm just saying that's a fact, okay? And over the course of our existence, whether you want to call it from protecting ourselves, like in our defense budget and all the wars we've had to finance, if you will, we've accumulated debt, but we've also accumulated a lot of assets along the way. Back to my analogy of the $30,000 mortgage on a $200,000 property. So again, sometimes we have to look at this from the whole. This also, by the way, leads into other conversations about the currency and things I've touched on here with the BRICS whole thing going on. And so this week's show was really quick, and I wanted to be very to the point in saying this. I've had a lot of conversations, and debt is an issue, but it's not the issue. Debt will always be something that we have had as a nation simply because of the way that we operate. And again, not to say that's good or bad, but I do think it's important for us as investors, as we look at our retirement plan, and we look at our portfolios and overall investment accounts, that we put this into context. And so with that, I want to leave you to your week. It was a quick and short one this week on purpose because I really just wanted to kind of go back and look at a timeline of what's going on. I want to thank you for listening to the Make Your Money Matter show. As always, before acting on anything discussed today, speak with a financial advisor near you about your specific situation. Or again, if you'd like our help, you can reach us at 805-410-5454, or you can go to our website again at onecapital.com. And until next week, always remember to make your money matter.
The information in this show is educational and general in nature and does not take into consideration a listener's personal circumstances. Therefore, it is not intended to be a substitute for specific individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.